Imagine walking past a Fifth Avenue flagship and seeing Balenciaga bags listed at 40% off in plain sight. Imagine logging on to a major Chinese marketplace and finding brands that used to hide their discounts now splashed across the homepage. If luxury used to mean you could never buy it on sale, that rule is cracking. Why are major labels and department stores openly advertising 30 to 50% markdowns in early 2026? And what does that mean for how the ultra-wealthy display, hide, or even monetize their wealth? Over the next 14 minutes, this narration unpacks the mechanics from inventory cycles and platform effects to China demand and outlet flows and explains the bigger cultural shift. The status economy is changing. I'll lay out numbers and case studies, show how platform and resale metrics matter, and explain strategic responses from brands and wealthy buyers. This is an educational analysis, not financial advice, drawing on industry reporting and public signals to interpret what these discounts reveal. Stay with me. The part about how wealthy buyers quietly adapt is the surprise twist. Start with the immediate observation. In 2024 and into early 2026, large luxury discounts became more visible and broader in scope than in recent memory. Reporting shows Balenciaga's sale activity in China averaged around 40% off on merchandise during parts of 2024, and US department stores organized January designer events in early 2026, advertising 40 to 65% off top labels. Retail calendars and reporting reveal concentrated windows where discounts are not hidden in back rooms or outlets, they are broadcast to the public. Visible markdowns at that depth are a structural shock to a sector built on price-anchored exclusivity. Traditionally, luxury houses relied on quiet private sales, client lists, and off-price channels like outlets to protect a public facade of scarcity. Now, discounts are public, large, and frequent across channels. That changes the rules of the game. Several immediate drivers converged. Stretched price elasticity after years of hikes, carryover inventory without new cult hero products to absorb it, and concentrated retail events designed to convert inventory and restore cash flow after a softer season. In short, too much product and not enough willing full-price buyers. If you want to see why public markdowns went mainstream, look at China. Online platforms represent a huge share of luxury revenue in China, which makes marketplaces a high-leverage amplifier for discounts. Early public markdowns on major Chinese platforms accelerated visibility. Cross-border dynamics also matter. Japanese shopping became more attractive as the yen weakened, and Chinese consumers became more selective after reopening. By mid-2025, several brands deliberately dialed back steep public discounts on Chinese platforms to rebuild desirability. So discounts were both a symptom and a lever used to clear inventory and then pulled back to try to restore brand aura. Ask yourself, is the Chinese market shifting permanently from price-insensitive to price-sensitive? Or did brands temporarily miscalculate demand elasticity after years of steep price increases? The answer is both. Changing household consumption patterns mean demand is more elastic now, and brands learned that the hard way. Now let's talk retail mechanics. Department stores and omnichannel retailers use concentrated events, private sales, loyalty member windows, and headline designer events to move inventory fast. Promotional calendars in early January 2026 showed multiple stores offering 40% or more off as a headline. That normalizes consumer expectations. If the calendar says designer event 40% off, shoppers begin to expect that as the default. Often, these events are retailer mechanics rather than pure brand decisions. Retailers face their own inventory and cash flow stress, so they pressure buying brands and push on price to stimulate traffic. When retailers hold the megaphone, brands lose channel control. That's why the same discount depth appears quickly in department store windows and on marketplaces. Think of this like a leaking dam. If one store opens the gate and discounts publicly, shoppers flock to it. Other stores follow to avoid losing market share. Soon, the discount level becomes an industry headline, not an isolated policy. Platforms are the accelerant. Marketplaces scale markdowns instantly, and resale platforms act as a shadow market that shapes primary market behavior. Resale reports in recent years showed nearly half of consumers consider resale value before buying new. That means buyers check a handbag's resale performance before paying full price. Heavy public discounting can compress resale values for broadly produced fashion items, making some goods less desirable as investable pieces. At the same time, genuine scarcity in collectible items hold or even increase in resale value. Platform data creates a feedback loop. If resale prices fall for a brand's typical SKUs, future buyers become more hesitant to pay full price, pressuring primary margins further. Who controls perceived value? The brand or the marketplace where its secondhand price is set? Now for the broader cultural read. Price-anchored exclusivity was the core status signal for decades. The higher the price, the stronger the social credential. Visible deep discounts weaken that simple equation. When a Birkin or a trending sneaker is repeatedly visible on sale, price loses reliability as a status credential. But status doesn't vanish, it fragments. New signal vectors emerge: provenance, limited editions, experiential access, curated vintage, and demonstrable resale performance. Younger consumers, less motivated by sticker shock and more by curation and authenticity, shift towards social proof and peer curation. Brands must now compete on narrative and scarcity design rather than purely on price. Luxury houses are splitting into two strategic camps. One path is ultra-luxury houses that maintain tight control, strict pricing, limited channels, and resisting public markdowns. Those houses believe price discipline preserves long-term equity. The other path is mid-tier and fashion luxury players who accept public discounts to maintain cash flow or market share. Industry reporting showed margins compressing in 2025, forcing choices. Some brands protected margins by reducing production and pulling back discounts. Others leaned on sales to clear inventory, accepting short-term margin erosion. Strategic repositioning isn't just about discounts. Houses that keep exclusivity invest in clienteling, private appointments, bespoke offerings, and strict control over outlet flows. Those leaning into discounts operationalize outlet and off-price channels as deliberate volume levers and accept that some SKUs will behave like premium consumer goods, not status objects. This is the part many listeners care about: how wealthy individuals react. Public, visible discounts disrupt the social utility of ostentatious luxury. When a visible queue no longer reliably signals exclusivity, wealthy buyers adapt. They shift to private channels, concierge buying, bespoke pieces, and experiences that can't be discounted publicly. They increasingly use luxury as a financial asset: buy, use, and resell. If a handbag has strong resale performance, a wealthy buyer might buy it at full price, use it for a season, then resell it to capture value. That converts conspicuous consumption into a liquidity management tactic. An important caveat is that hard quantification of wealthy buyers' concealment behaviors tied specifically to public markdowns is limited. The implication is plausible and supported by advisor interviews and marketplace signals, but it's not a precise measure. Not all product categories behave the same. Iconic handbags, certain watches, and select jewelry with provenance or limited runs hold resale value better. These remain investable, and buyer demand persists. Meanwhile, seasonal fashion items and mass-produced logos see resale erosion when primary markets go on sale. Think of the luxury market as split into collector grade and consumable luxury. Collector grade, small batch, provenance, historical cachet gain status as price-anchored cues weaken. Consumable luxury becomes more like premium apparel, nice but fungible and sale-driven. Discounting creates mixed incentives that can self-reinforce. Public markdowns lower secondhand prices for mass items, which reduces first-hand buyers' willingness to pay full price, pressuring brands to discount again. Retailers facing slack demand push earlier and deeper promotions to hit sales targets and loyalty metrics.